They fear price fluctuation and therefore they don't act. If you add Bitcoin to a portfolio, your volatility overall goes down and your long-term compounding goes up. Yes, institutions are here, and yes, ETFs are buying and huddling, and yes, some hedge funds are buying and huddling, and yes, some Bitcoin treasury companies are buying and huddling. People are adding it, and now you're seeing this relentless accumulation. Bitcoin is on a tear, not necessarily just price. There's volatility. As Michael says, volatility is vitality. That's what creates the opportunity. Lots of people underperform long-term as investors because of one really simple idea, which is they fear volatility. And by not acting, you stay too conservatively postured and inflation chews up your return and you get less rich. Today, we have none other than Mark Yusko discussing his prediction for the entire crypto market, mainly due to institutional capital, which he plays a very large part in, and of course also all of retail that is just flooding in as of recently. What we've been seeing is institutions consistently buy the dips when retail panic sells nearly time and time again. And this is creating a dynamic where institutions are accumulating record numbers of Bitcoin and basically siphoning those very same funds away from retail holders who maybe are a little bit too paper-handish. And so this is a really important video that I'm sharing with you guys today, because if you guys want to hold on to your stake in XRP, right now is a really good time to pay very close attention, because institutions are using a number of different psychological tricks and triggers in order to ensure that they can take your XRP, your HBR, your Bitcoin, your cryptocurrency. We're going to talk about all of that today. I want you guys to listen very closely. I think this is a really valuable video that I'm sharing with you guys here today. Hit that like button. Let's get into it. Building a portfolio. What's interesting about Bitcoin in particular as a portfolio diversifier is it's highly volatile because there's a lot of uncertainty across the masses on the future. I know yesterday I retweeted something said Bitcoin going to zero since 2009, correct? Right? There are people that still believe, it's hard for me to fathom actually, there's people still believe to this day that, oh, it's Ponzi scheme, it's fatted, it's going back to zero. Well, it's never going to zero for lots of different reasons. No. And the likelihood is this volatility that has been around 80-ish, which by the way is the same as Amazon stock, which we can come back to at some point, is probably going to decline over time as more people become convinced that this is the future of money. But the best thing about it is volatility is one measure of an asset in your portfolio, but another is correlation to the other assets. Think about it, if I own bonds, super risky strategy actually. Oh no, Mark, there's no volatility. Well, right. But then you get chewed up by inflation, so you get less rich. That's pretty risky. Correct. So if I add equities, which on the surface seem riskier because they have higher volatility, but they're uncorrelated to bonds, the risk of my portfolio actually goes down. That's what Markowitz won the Nobel Prize for. And when you add Bitcoin, which is highly volatile, but uncorrelated to bonds and uncorrelated to stocks at 0.0 correlated to bonds and 0.5 correlated to stocks, your whole portfolio volatility actually goes down. No, that's not possible. What is now, that doesn't mean every day, every minute. But alongside of that maturation of the market or institutionalization of the market, now we have futures and we have options. And when the financialization of a commodity, now this is one of the be careful what you ask for things. Remember the whole argument about, oh, Bitcoin is not a security. And we love that they called it a comm. Okay, but think about it, commodities. Okay, like gold, wheat, corn, oil, do they have high volatility or low volatility? They kind of have high volatility. And can those markets be manipulated by the big institutions? Gold has been manipulated. I love the fact JP Morgan got caught, right? Red-handed caught manipulating the gold market, paid $1 billion, 960 million, so almost $1 billion fine. And they're like, without admitting wrongdoing. Love that part. Didn't do anything wrong, but we're paying this $1 billion fine. And the guy said, well, look, it's just a cost of doing business. We made 20 billion, we pay 1, it's not bad. Now you shouldn't have been doing that, but they do and they get away with it. If you go back to 2018, the price went from 10,000 to 20,000 in about 6 weeks post-Thanksgiving into the second week of December, and then it crashed, right? We went in a big crash. And by middle of 2019, it was all the way down at, 3,200 or end of 2019, back down to 3,200. Well, interestingly, literally on the day, December 18th of the peak, the CME issued new futures. Well, what does that mean? Well, a future allows a big institution to go short. Now, you're not supposed to do that, but again, rules are for other people, because if you're an institution and you want to buy something, you don't tell everybody how great it is and you push the price down so you can go accumulate at a lower price. I mean, the big hedge fund guys, you do this all the time. Julian Robertson, George Soros. Fast forward to 2021, the price peaks again. The CMA issues more futures. So right as you get the approval of the ETFs, people can go short against the box. But it's like, look, Millennium owns $2 billion of Bitcoin. Well, they don't. They don't own 2 billion. They are short at least 2 billion, maybe even a little more sometimes, but mostly they're mark T neutral, but they're short. So as the futures market has evolved, that volatility that should be going down to your point actually keeps rising. Therefore, there's going to be activity in paper, not real Bitcoin, but paper Bitcoin. Think the most interesting point that Mark Yusko makes here is that holding cryptocurrency XRP Bitcoin actually reduces the volatility of your overall portfolio. Now, this might seem counterintuitive, especially in the short term, because we all do know that crypto has some of the wildest fluctuations in price in the short term. But long term, what you see is if you are holding Bitcoin versus corn or oil, your portfolio is going to consistently climb over that other one where you're holding oil. And I think that's a really important point to note. The consistent outperformance of Bitcoin, look at 2009 Bitcoin performance all the way to 2025. Look at 2016, 2018 XRP performance all the way to now. It's pretty much a no-brainer, right? You were wanting to hold these crypto assets over commodities almost every single time. It just makes a lot more sense. Your portfolio will grow a lot more quickly, and it's a newer industry that a lot more people are getting involved into. Institutions are going to start buying XRP very soon, just like they have been buying Bitcoin for the last couple of years now. ETFs have allowed billions upon billions, some would argue even near $1 trillion of capital to flow into Bitcoin. Now imagine this, we have XRP who now has the ability to do the very same thing. We're already seeing the effects of this on the Ethereum ETFs. It's picking up an insane amount. Ethereum has been going ballistic simply due to ETFs as well. So I do think there is a ton of potential here, and a lot of people are sleeping on the just potential of that one thing, just the ETFs. That's not even talking about all of the other major catalysts, and there are a lot for XRP right now on top of that. And so I think Mark Yasko does a really good job of explaining this ongoing phenomenon and why essentially holding cryptocurrency is actually better than holding commodities and why you might not want your XRP to be a commodity. Now, he does have one more important point to make that I want to share with you guys. Let's hear that, and then I'll get into a really crucial point towards the end. Make sure you stay tuned for it. There's always method to the madness. There was a reason that they deemed it not a security and as a commodity. That wasn't by accident. That wasn't so they could ignore it. It was so they could financialize it and control it, tame it. There's TradFi, traditional finance. There's DeFi, which is the future decentralized finance. But in the middle, there's this thing, rocky road called CFI, centralized finance. There's a process. So there are absolutely people who are all the way over here in DeFi. They are self-sovereign, be your own bank. They own their keys, their coins. They're on, hard drive or whatever. I mean, I know a ledger or whatever, and that's great. Now, we all know people lose the ear password. They lose their seed phrase. They have a boating accident, whatever it is. So it's a bearer asset. Bearer assets have unique risks. And so you think about money. Think about in the old days, money was I had chickens and you had cows. Yeah, that was our wealth. And we would come to the market and we would trade those physical animals. And that's how he did was barter. And they're like, that's stupid and it's messy. So I'm going to bring these little coins with chickens on them. And you're going to bring these coins with cows on them and we'll trade the coins. Well, but those sacks of coins were heavy. And on the way home, the robbers came and knocked us over the head and took the coins. So we put the coins in the bank. Now we have these IOUs, these pieces of paper that we could trade. So then we electronified, right? We made QCPs, ones and zeros in our bank accounts, and we would trade the QSIPs and we would trade the bank account ledger numbers. And that was better system. But the problem was it was centralized and traditional in the sense that you put your money in the bank, it's now the bank's money. Put your money in a brokerage firm, it's now the brokerage firm's money, it's not yours. Now have an IOU and it works most of the time, but it's not yours. You're not self-sovereign. Well, Bitcoin comes along and says, well, I can fix that. I've created this ledger, triple entry accounting. So we know exactly who owns the Bitcoin and I can own it myself without any intermediate. That's what peer-to-peer means, right? In the old days, I want to send you money. I have to have a bank account. You have to have a bank account. I have to send you, I pay a fee. If it goes across international borders, I pay another fee to the Rothschilds, because of a treaty for like 400 years ago. It's ridiculous. I mean, it's literally ridiculous that if I send money across international borders, I have to pay one of two banks because of a treaty from hundreds of years ago. That is ridiculous indeed. With that being said,